Alright, welcome everyone. I hope you guys are doing okay. Welcome to another video lectures. So in today's video we will start chapter 10 and I will try to go as much as I can. But probably we're going to cover half of the chapters. So chapter 10 we will talk about property acquisition and cost recovery, and majority of the time we're going to talk about cost recovery, so okay, so I guess let's start. So as you know, and we kind of touched on this a little bit in previous chapters, right? For expenditures, especially for business expenditures, some expenditure you can expense right away, but some expenditures you cannot expense. Right? You have to capitalize it. Right? So I believe in previous chapter we will talk about this. So for the cost of capital, for the cost of assets with a useful life of more than 1 year, we have to capitalize the cost, right, the expenditures, right, and then over the time during the useful life of the properties of the asset, we kind of try to recover that cost, right? And the recovery method, it can be the depreciation for a tangible asset, or amortization for intangible asset, or depletion for some thing such as resources, natural resources, right? So it's depending on the type of asset we're gonna apply different methods, right? So as we just mentioned, right? So there's three main way to recovery a cost: depreciation, amortization, and depletion. Right? So again, depreciation is to recover the cost, right, of tangible asset or real property, right? So and then for amortizations, this is the method to recover the cost of intangible assets such as patents, right, or goodwill, right? So those are intangible assets, and usually they have a specific lifespan or useful life. So we're going to amortize the useful life of we're going to amortize the cost during the useful life of the asset, right? And then depletion is to recover the cost of natural resources, right? So and here just like a summarization, a summary of the type of method to recover cost, right? So in today's lectures we probably spend the whole time talk about depreciation, because it's the most complicated, the most complex method. There's a lot of rules that we have to learn in this chapter about depreciations, and also it's probably the most common method to be used, right? Because majority of the company have intangible assets, right? And then probably in the second video I'm going to talk more about amortization and depletion, right? So for today, for this video, probably we're going to focus on depreciation for most of the time. Alright, so before we go deep into the depreciation method, let's talk about the basis, right? The basis of assets, right? So as you probably already learn in financial accounting, to be able to depreciate an asset, we have to know the basis, right, of the asset, right? So the basis of the asset is pretty much like the amount that you invested in to acquire the asset, right? So that's the initial acquisition of the asset, right? And once the assets start to put into use, right, then the depreciation or the recovery cost of the assets start to kick in, right? Start, right? So as I mentioned, the basis, right, of the basis of the asset usually is the initial cost to acquire the asset, right? However, for tax reporting purpose, there might be other additional costs that are associated with the asset that you may have to account for, right? For example, if there are some additional expenditures used to improve the performance of the asset, to restore the asset. If the asset has been used for a while, then you're going to restore it, or want to change the purpose of use of the asset, right? So for example, if there's a truck and you have been using the truck for as a delivery truck, and then now somehow you want to change the purpose of the truck to become a food truck, right? So the cost of the transition, the cost of the adjustments can also be need to be capitalized and need to be recovered over the period over the periods of useful life, right? So pretty much all the costs that I just mentioned, right? The costs that are all the expenditures that are related to the betterment, the restoration, or the change of purpose of the properties, the assets, need to be added back to need to be included in the basis of the asset, right? And then the owners have to either depreciate or amortize over the period of time of useful life. All right, so and then for expenses that are related to routine maintenance, then for those kind of expenses, for those kind of expenditures, the owners can expense right away, right? Then don't need to include in the tax basis, right? So let's look at this example. Maybe it's gonna explain itself a little bit better. Right, so this company, Scrap Happy Incorporation, scrapbooking retained chain, purchased an old office building for $175,000 for use in expanding its current operations. An additional of $15,000 was spent painting, remodeling the building in preparation for its opening. Right. 2 years later, Scrap Happy employee discovered that several leaks in the roof were causing serious water damage to the store's inventory, and then this company spent another $50,000 to re-roof the building. And every 6 months, Scrap Happy pays $500 to have the carpet professionally cleaned. Alright, so the question for this problem is to calculate the tax basis for the building that this company purchased, right? So we know that the initial investment, the initial cost of the building was $175,000, right? And then before putting the building to use, the company spent another $50,000 to remodel, to fix the building, right, before they put that into use, right? So in total, initially the building cost the company $190,000, right? And then the company also found out a few years later, 2 years later, they found out there's a leak, right, that need to be repaired, right, or restored to make sure that the building is usable, right? And they spend another $50,000 to re-roof the building, right? So all of these costs, right, they are either initial costs or the costs that are associated with fixing, restoring the building, right? So for that reason, all these costs is going to be the 175, the 15,000, and the 50,000 is going to be included in the basis of the building, right? And then this $500, it is the routine maintenance, right? $500 to have the carpet cleaned every 6 months. So because this is an expense that are associated with the routine maintenance activities, then the company can just expand this right away, right? They don't have to capitalize this $500. Right. So yeah, so let's look at this, right? So exactly, right? So initial cost 175, painting, remodeling 15. So the original basis is $190,000, and then we also have to added the $50,000 of re-roofing expenditures to the basis of the building, right? And then the $500 is a routine maintenance, so we don't have to add that back to the basis, right? All right. So I hope this example make it clearer about the basis, right, about the tax basis of an asset. It should not be that hard, It's pretty straightforward and basic. So yeah, so you guys should feel comfortable with this, I think. All right, so let's talk about depreciation. Okay, right. So as you know, well, probably all of us are familiar with the concept of depreciation, right? So depreciation, as I mentioned earlier in this video, is one of the main methods that can be used to recover the cost of an asset, right? So depreciations for book purpose, for financial reporting purpose, and for tax purpose are relatively similar, you know, but still there's some differences, and we're gonna talk about those differences in a little bit. But yeah, but let's talk about the Tax Cut and Jobs Act, right? So TCJA. So this is an act. This is a I can say it's a law that passed after President Trump got into office, and it kind of makes several changes, makes several adjustments in the way we can depreciate assets for tax purposes, right? But I'm not going to talk. I'm not going to go deeply into this. You know, I just want to introduce you to use like there's such act, and it's been imposed recently. It's been passed recently, and it's kind of changed the way we depreciate assets for tax purposes a little bit. And the majority of change focus on the the exception, exceptional option for business to choose to that allow business to choose to expense some qualified expenditure right away, and without the need to capitalize the asset, right? And it's called Item 179, expensing and bonus depreciation. So I believe we should talk about this probably in the second video of this chapter. But yeah, I just want to introduce you guys beforehand. There's this act, and this has changed the way we depreciate assets quite a bit. All right, so okay, so let's talk about the technicality of the depreciation method. Right. So for tax purpose, since 1986, we have been using a system called MACRS, right, which stands for Modified Accelerated Cost Recovery System, right? But we call it MACRS, right? And this system makes it easier for tax accounting to account for tax expenditures of assets, right? So as you remember, for financial accounting, in financial accounting, the way we depreciate the assets can be very subjective, right? It depends on the method that are selected by the business owners, and the time spent, the useful life of the assets are also estimated by the business owners, right? So it's kind of hard to find a good way to estimate the good useful life, right? But in for tax purpose, the useful life of an asset has already been determined for the business owners, right? And that because of the MACRS system. So the MACRS system, it help set our rule to depreciate asset for tax purpose, right? And the MACRS system basically is calculate a predetermined percentage that you can apply to calculate the depreciation and expenditures for tax purposes, right? Based on the types of the assets, based on the time, the useful life of the assets, right? So we're going to discuss it in a little bit. Right. So to apply the MACRS depreciation system, right, we need to know a few little things to be able to apply it, right? And everything is systematic, so that's why it's pretty much it's a little bit easier to calculate depreciation for tax purposes than financial accounting, right? Because in financial accounting there's a lot of estimates involved, right? Because we have to estimate the useful life of the asset, and how much you think the the assets should be depreciated, right? But for makers, everything is predetermined, so it's make the life of the tax accountant a little bit easier, right? So to be able to use makers, first we have to know the cost, right? The asset basis, right? Initial basis, and then the date that the asset was placed into use, right? So when do the businesses start to use their assets, right? Start to apply the assets, and keep in mind that it's different from the date that they bought the asset, right? Because the company may bought the assets like years ago, but they don't use it, and they keep it there in their warehouse, right? And then after a few years after they bought it, they put it into service, right? So here's the date that we talk about. Here's the date that the company put the asset into services, right? So, all right, and then so first, that's the first two item, the first two things that we definitely need to know, right? And then depending on the types of assets, right, whether or not it is a personal asset or whether or not it is a real property, right? Then we can select the applicable depreciation method and depreciation recovery period, and also the depreciation convention, right? And so let's talk about first. Let's talk about the types of asset that we can that kind of determine all of this option that we can select, right? So I mentioned there's two main type asset, right? So there's personal asset and there's real assets, right? Real properties, right? So personal asset or personal properties include all tangible assets, right? Including computers, cars, furniture, machinery, equipment, right? Anything except real property, right? And keep in mind that personal property is different from personal use property, right? So personal properties pretty much just means any property other than real property, right? And it can be business use or it can be personal use, but well, in this case we're talking about business use, right? So it's different from personal use, right? But I don't know why they call it personal. I don't know why they pick this word. You know, they can call it something else, but they call it personal properties, just to differentiate between real properties and all other properties, right? So again, I just want to stress that personal property here means all properties, all tangible properties, except for real properties, right? And real properties mean buildings, warehouse, those kind of stuff, right? So first we're going to talk about how we can, what are the options for us to choose to depreciate personal properties, and then we're going to talk about how to depreciate real properties, right? All right, so for personal properties, there are three type of method that we can choose from, so the 200% or double declining method, the 150% declining method, or the straight line method, right? But by default, business should use the 200% or the double declining method, right? But they have the option to choose to switch to 150% declining method or straight line method. So in this chapter, we're going to mainly focus on talking about the default method, which is the double declining method, right? So every year, business can choose a depreciation method that they want to use for the assets that are placed into service during the year, right? So let's say in 2018, this company choose to do double declining method for all the assets that they put into service in 2018, right? And then 2019, somehow they changed their mind, and then now they elect to switch from the default method to, say, a straight line method, right? So then in 2019, they're gonna use straight line method, depreciation method, for all the assets that are placed into service in 2019, right? So each year, the businesses have the options to select or to change the depreciation method for their personal properties that are placed into service in in that particular year. All right. So so that's the method, right? So now we'll talk about the recovery period, right? So as I mentioned, right, for financial reporting purpose, the businesses have to estimate the useful life of the asset, right? But for tax purpose, everything is set out, everything is predetermined based on the type of assets, right? So there are some tables that we can use to calculate to figure out that predetermined rule we can apply to calculate to figure out the recovery period, right? The useful life of the asset, right? So let's look at this table. So here is a detailed classification of asset, and also it tells us the recovery period, right? The useful life that for tax purpose that the IRS already calculated for us, right? So for office furniture, fixture, and equipment, the recovery period is around 7 years, right? Information system, computers, and equipment, usually the general recovery period is 5 years, right? So here are like a very detailed table, right? But for simplification's sake, we have this table, right? So this table pretty much sum up all of the most common personal properties that we can that are used, right? So pretty much there are two main type of personal property that we should pay attention to, right? First of all, for 5 years recovery period, we have cars, light general purpose trucks, right, like pickup trucks, computers, and peripheral equipment, right? For office furniture and equipment, usually the recovery period is 7 years, right? So this is like a simplified table for this table, right? But this table should help us make it easier for us to apply it. All right. So after we figure out the recovery periods, now we need to figure out the convention. So convention, what does it mean, right? Convention, kind of weird. All it means is it's a type of system that we can use, method that we can use to apply to determine when or how can we depreciate the asset for the first year and the last year of the asset, right? So for half year convention, basically we depreciate half year worth of depreciation expense for the year of acquisition of the asset, right? And then the second convention that allowable for personal expenditure is mid-quarter convention, right? Basically, depending on the quarter of the quarter that the asset put into services, we can apply the right quarter, right? So let's first talk about the half-year convention first. The half-year convention, what it allows us to do is it allows us to apply to depreciate 1/2 of a full year's depreciation in the first year and the last year of an asset's life, right? And usually is this the default convention, right? Unless there's some condition apply, and then we have to use the mid-quarter convention, right? But yeah, so what my train of thought. Oh, okay. So because this rule is pretty generous, right? It's allowed. So for the first year of the asset life, right, it allows half year of a full year depreciation numbers, right? So a lot of businesses, a lot of business owners, they kind of take advantage of this rule. So some people would put into service some asset by say December 31st, right? On December 31st, even though they don't use the asset at all in that year, in the tax year, they still want to do that because they want to claim the half year of depreciation expense, right? So for those business owners, they put into service the asset on December 31st instead of say January 1st, right? December 31st and January 1st is no difference to them, right? But somehow they choose to put into service. They choose to use the asset starting December 31st so that they can claim the half year convention, right? The half year of the depreciation expense, right? So that is bad, right, to the IRS, because they lose because these taxpayers, these people, these companies, they trying very aggressively to avoid paying taxes, right, by claiming that deduction, right? So because of that, the IRS came up with the mid-quarter conventions, which is created to kind of prevent that kind of action, right? That kind of tax avoidance actions, right? So for mid-quarter convention, if greater than is more than 40% of the properties of the asset are placed into service in the last quarter of the business tax year, then the business have to use the mid-quarter convention. And the mid-quarter convention, the amount of depreciation expense allowed is much less than the half-year convention. So we can go through several example later to see how different they are, right? But overall, the half-year convention give much more allowable depreciation expense than the mid-quarter convention, right? Right. So what does the mid-quarter convention allow business to do? Right. So the mid-quarter convention is only allow business to depreciate half of the quarter depreciation in the year that the business is put into service, right? So comparatively speaking, the half-year convention allow business to deduct half full year of depreciation expense on the first year of asset life, right? Whereas the mid-quarter convention only allow asset to deduct half of the quarter depreciation expenses, allowable depreciation expenses for the first year that the asset is put into service, right? So again, the half-year convention is much more preferable for businesses, right? Because it allows more deduction, more depreciation expenses, right? I'm gonna show you the difference between these two in a little bit when we solve some example together. Right? All right, so let's see. So let's try to determine whether or not each of this scenario is we need to apply the half-year convention or mid-quarter convention, right? So let's see. So for the first scenario, there's three assets that this company put into service, right? So office furnitures, they acquired, and probably the assumption is that after they acquire, they're going to put into service right away, right? So they acquire office furnitures is February the 3rd, and the machinery, the acquisition date is July 22nd, and then delivery truck is August the 17th, right? So, and then they, based on the date of the acquire, we can determine the quarter acquired, right? And then here the cost basis of all of this asset, right? So for office furniture, the cost basis is $20,000. For machinery, the cost basis is $10,000. for the delivery truck, the cost basis is $25,000, right? But let's look at this, right? Look at the quarter acquired. All of these assets are acquired or are put into services on either on the first 3 quarters of the year, right? So that means none of them are placed into service on the 4th quarter, right? So meaning in this scenario, in this case, the business can use the half-year convention to depreciate the assets, right? But let's look at this second scenario, right? So same type of asset, same cost basis, but now the machinery is acquired on November 22nd, which is in the 4th quarter, right? And then the cost basis of this is $10,000. So now, obviously, right, $610,000 divided by $655,000 is way more than 40%, right? So because of that, we have to use the mid-quarter convention for this scenario, right? So yeah, I just want to show you how we can determine whether or not we can use the half-year convention or the mid-quarter convention, right? And and look at this as well, right? So look at the recovery period, right? So remember, depending on the type of asset, the recovery period is going to be different, right? So office furniture, machinery, the recovery is 7 years, but for delivery truck, the recovery period is 5 years, right? Now, it's not related to this problem, but I just want to show you because we talked about this earlier, right? All right. So how do we calculate depreciation? So here are the 4 steps that we can use to calculate the depreciation, right? So first of all, we determine the appropriate convention, right? Whether or not it is a half year or whether it is a mid-quarter convention that we can use, right? And then the second step is to locate the applicable table, right, based on the convention, okay. Right? And there are some predetermined tables, pre-calculated table that we can use. We can just use that table to determine the percentage that we can use, right? Alright, so that's the second step. The third step is to select the column that corresponds with the asset recovery period, right? So based on after we figure out the convention, now we know we pick a table, and now based on the recovery period, right, either whether or not it is 5 years or 7 years, then we'll pick the right column, right? And then depending on the year that we're trying to calculate the asset, try to calculate the depreciation expense, then we're going to select the row, right? So let me show you. So here is here's a table for the Mako table for half-year convention, right? And then the method here is by default the double declining method, right? So first of all, by applying the first step, right, we determine the appropriate convention. So here here's a table for half-year convention, right? And then so we know we find the table, right? And then depending on the recovery period, right? So we have 3 year, 5 year, 7 year, 10 year, 15 year, 20 years. But what we mostly talk about, at least in this class, is going to be in for 5 years and 7 years, right? So the 2 columns that we're going to pay attention to most of the time is going to be this 2 columns, right? 5 years and 7 years, right? So now we know the columns, and then depending on the years that we're trying to calculate the depreciation expense, we're going to select the row, right? So let's say I'm trying to calculate the 3rd year depreciation expense for an asset that I put into service 3 years ago, right? So for the 3rd year, and then the asset is a truck, right? So a truck recovery period is 5 years, and then for the 3rd year, the depreciation percentage is going to be 19.2%, right? So I know the year, I know the recovery period, I know the year, so I can figure out the recovery period, the percentage, depreciation percentage, right? Right. So let's look at that example, right? So it's a Titan, which is a company, is using 200% declining balance method and half-year convention to compute depreciation expense on its 2018 personal property additions. Right, so this company, they put into service these three items. Right, on here's a date they put into service. Right, so for office furniture, they put into service on February 3rd, machinery July 22nd, delivery truck on August 17th, and here are on the original basis. Right, so for the first one, right, for office furniture, right, original basis is 20%, and since we are trying to calculate the first year depreciation expense for the asset, right, so we go back to the table, first year, and then furniture is a 7-year. They have a 7-year recovery period, right? So first year, 7 year. So the percentage that we're gonna apply is 14.29%, right? So the rate is 14.29%. So then, to calculate depreciation expense, we just take the original basis times the rate, and that gives us the depreciation expense for office furniture. Right? And then we just keep following the same process to calculate the depreciation expense for machinery and the truck here. Right? So machinery, the recovery rate, the recovery period is still 7 years, right? So so that's why we're going to use the same rate for machinery, right? So we take original basis, multiply by 14.29%, and that gives us a depreciation expense for this machine, right? And then delivery truck, because delivery truck recovery period is 5 years, right? So we look at the table again, 5 years, 5-year recovery period, and then the first year, so the percentage is going to be 20%. Right? So we take the original basis of $25,000 multiplied by 20%, and that gives us the depreciation. So that's how you calculate the depreciation expense. And what we talk about is the half-year convention. All right. In this example, we're just trying to calculate the depreciation expense for every year, right? For every single year of during the recovery period, right? So you can see for 7-year office furnitures, by applying the rate, we can calculate the expenditure expense, the depreciation expense for every single year, right? And then keep in mind that there are 7 years of office. There are 7 years of recovery period, right? But if you look at the period here, there are actually 8 years, right? So what happened? Well, what happened here is that in the first year, the IRS allowed the company to depreciate half of the year, right? Half of the full year depreciation expense, right? So that's why in the year that the furniture, the asset is put out of service, the IRS also allow half-year depreciation for that year. So that's why it's make it 8 years here. Right? So even though the useful years is only 7, but the 8th year is the year that they supposedly have to dispose this asset. Right. All right. So let's talk about how to apply half-year convention for like for the year of deposition, if the company decide to dispose the asset before the recovery period ends, right? So let's look at this example. Right? So it's assume Titan sells all of its office furniture in 2019, which is 1 year after they buy it. Right? Now, what is Titan depreciation for the office furniture in the year of the disposition in 2019? Right. So to calculate the depreciation expense of the year for the year of disposition, we follow 2 steps. Right? So first, we calculate the depreciation expense for the entire year, as if that the property had not been disposed at all. Right? And then after that, we just take half of that. Right? So we multiply that amount by 50%. Right? So basically, the IRS, they allow us to depreciate half a full year depreciation in the year of of the disposition, right? If the disposition happened before the end of the recovery period. Right? So for this, in this case, for this firm, they're selling all of their office furnitures, right? So first, we calculate depreciation expense for the entire year, for the second year, right? So we look at the table again. So second year for furniture, right? So the rate is going to be 24.49, right? Because furniture has 7 years of recovery period, and then now we try to calculate the second year of depreciation. Right? So the percentage rate is going to be 24.49. Right? So let's get back to our example. So we take the basis, right, which is $20,000 times 24.49%, and that gives us the full year depreciation for the second year, right, which is $48.98. Right, and then we multiply it by 30%. Right, so now that gives us the allowed depreciation expense for this year for furnitures, right, in the year that they dispose the furnitures. Right, I hope that is clear enough. Right, and so yeah, so all you need to remember is if the company try to dispose the asset before full depreciation, right, before the end of the recovery period, you are allowed to depreciate 50% of the full year depreciation in that year, right? So pretty straightforward. All right, so that was half year convention. So let's talk about applying the mid-quarter convention, right? So here are the tables for the mid-quarter convention, right? So for mid-quarter convention, there are, depending on the quarter that the company put the asset into service, right, we have to select a table accordingly, right, based on the quarter that the company put on service, right. So here the first table is a mid-quarter convention for property placed in service during the first quarter, and then we have table 2, 3, 4 for the rest of the quarters, right. So depending on the date that the asset is placed into service, then we have to pick the right table to use, right? So let's look at this example. So similar to the other example, same company, same assets, but the date that they put into service is just different now, right? So the office furnitures, the purchase date is February 3rd. For delivery truck, the purchase date was August 17th, and for the machinery, the purchase date was November 1st, right? So now we know that the machinery is put into service in the fourth quarter, right? And then we know that the machinery is very expensive, right? The basis for it is $610,000. So we divide, so that takes up about 93% of all of the assets that are placed into service during 2018 for this company, right? So that's why this company had to use the mid-quarter convention, right? So now, based on the quarter that are placed, that's just the issue of the asset is placed into service. Now we have to go back to select the right table, right? So for the first one, office furniture is placed into service in the first quarter, right? And this is a 7-year recovery period asset, right? So first quarter, 7 years, right? So it's going to be this table, right? So this is a table for property placed in service during the first quarter, right? And then for the 7-year recovery period, the first year rate is going to be 25%, right? So let's look at our example. 25%, right? So we determine the rate is 25%. Then we times the original basis by the rate, right? We take $21 times 25%, and that gives us $5,000 of depreciation. And this is going to be the depreciation for the first year of office furniture, right? All right. So that was the first item. The second item was delivery truck, and the truck was placed into service in the third quarter, right? And this truck is a 5-year recovery period items. So we go back to the tables, we select this table, right? So this table is for property placed in service during the third quarter, and the truck is a 5-year recovery period truck of assets, right? So the rate is going to be 15%, right? 15. So the rate is 15, right? 50% here, right? So we take $25,000 times 15%, and that gives us the depreciation expense for the first year, right? And then the last item, we just follow the same process, right? So this item is placed into service on the fourth quarter. So we select this table, the fourth table, and then the machine is a 7-year recovery period asset. So for the first year, the rate is going to be 3.57%, right? 3.57. Yeah. So that's how we calculate the depreciation expense for the machinery. Right? So as you can see, the mid-quarter convention is more complex than the half-year convention, and you compare the amount of depreciation expense allowed when you use the mid-quarter convention compared to when you use the half-year convention. You can see the depreciation expense is much smaller, right? So here under the mid-quarter convention, the total depreciation expense is going to be $30,000, right? But if we go back to our example for the half-year convention, the total depreciation expense was $95,000. So you can see the difference here. So that's why businesses prefer half-year convention way more than mid-quarter convention. Right. All right. So what about when the companies dispose the asset, right, before the recovery period, when they use the mid-quarter conventions, right? So similarly, we just apply the same process, right? So first we calculate the depreciation for the entire year, as if that the property had not been disposed of, right? So we calculate the full year of depreciation, the depreciation under the mid-quarter convention, and then we the second step. This step is a little bit different from what we do before, right? So in the second step, we multiply the depreciation amount by the time that have been held during the year, right? And by the time I mean the based on the month that the asset is disposed of, right? So let's say if the asset is disposed in the first quarter, right? So we take 1.5. This is the half of the first quarter, right? Divided by 12. So 1.5 months divided by 12 months, that gives it 12.5%. So we just take the full depreciation amount times 12.5%, right? To get to the depreciation expense for the year of disposition. Right? So depending on the quarter of disposition, we calculate the different percentage here, right? So let's look at one example. So in this case, it says that this company depreciate its personal property under the mid-quarter convention, and it sell all of its office furniture in the third quarter of 2019, which is 1 year after it acquired this furniture. So we know the basis of the furniture is $20,000, and it was placed into service in the first quarter of 2018, right? And then it has a 7-year recovery period, right? So now it asks us to calculate what is the depreciation expense for 2019, which is the year of the disposition. So first step, we calculate the depreciation expense for this asset as if there was no disposition. So we take $20,000 times 21.43%, and this rate, the 21.43%, is we can select from the table, right? So because the furniture is placed into service in the first quarter, we look at the first quarter table, and because it is a 7-year asset, we look at the 7-year column, And then since this is the second year that the furniture is put into service, right? So we select the second row that gives us 21.43%. Right? So that's where we get the rate from. So yeah, so after we get the rate, we know the full year depreciation expense for the furniture, right, in the second year, right? And then because the company, they dispose the furniture on the third quarter of 2019, right? So now we have to look at this table. Third quarter of disposition is third quarter. So we take 7.5 divided by 12, right, which gives us 62.5%. So now we take the full year depreciation expense times 62.5%, and that gives us the depreciation expense in the year of disposition. And remember that the year of disposition here is before the full recovery, the full depreciation happens, right? Meaning the company don't wait until the end of the useful life of these properties. They just sell it even though they're still useful life, right? All right. So let's look at this example. So it says in 2019, this company purchased and placed into service the following assets. Right? There's a machine which cost them $3,500, and they put this into service on February 2nd, which is the first quarter. Right? And then the second asset that they acquired this year was a computer, which cost them $1,200, and this computer is put into service on October 25th, which is in the fourth quarter, right? So we know that the machine the recovery period is 7 years, right? And then the computer, the recovery period is 5 years. So based on that, we can try to kind of select the right rate. But first, we have to calculate the right convention rate. So sorry for that. Right. So so in here we have some assets that are acquired in the fourth quarter. Right? So we have $1,200, and then the other machine is $3,500. So we take $1,200 divided by the total cost, which is $47,000, and we get 25.53%, which is less than 40%. Right. So because of that, we're going to use the half-year convention. Right. So we go to the half-year convention table. Right? But before that, let's remember it this way. So the computer is 5 years recovery period. The machine has 7 years of recovery period. Right. So we go back to the half-year convention table. Right. So for the 7-year recovery period, the rate for the first year was 14.29%, and then for the 5-year recovery period asset, the rate is 20%. So let's go back to our example. So so we know the machine is going to be. Let me open a Word file so we can type it. So for the machine, the machine, the basis was $3,500. Then we times that by how much? Sorry, I have very short-term memories. Times it by 14.29%. 14.29%. That gives us how much? 3,500. 500 times 14.29 or $500. 500.15 to be exact. And then for the I think it's a truck. No, for the computer, with $200. And the rate was 20%. So that was true $40. So this is going to be the expenses, the depreciation expenses for these two machine, for these two equipments, these two assets that the company put into services, right? Again, I just want to practice with you guys, how to use the table, right? But all right, so let's move on to, let's get back to our lectures. Right. So, and then they say assume that now the data place placed into service date, like switch, right, between these two assets. Now the computer placed in the first quarter, and then now the machine placed in the fourth quarter. So now, as you can see, right, the convention that is applicable here is going to be the mid-quarter convention, right? Because now the asset that are placed in service is more the basis of the asset that are put into service is equivalent to more than 40% of the total basis of the total of all of the assets that are put into service during the year, right? So we take 3,500 divided by 4,700, which equal to 74.46%, right? Which is way more than 40%, right? So now we have to use the mid-quarter convention, right? And then now similarly we have to go to find, now that we know the convention here is the mid-quarter, now we have to go to find the rate, right? So remember, computer is 5 years, machine is 7 years, right? And computer is put into service in the first quarter. So now let's go back. First quarter, 5 years. So the rate is going to be 35%, right? And then the machine is put into service in the fourth quarter, and the machine is a 7-year it's a 7-year recovery period asset. So the rate here is going to be 3.57%, right? So let's get back to our problems. Right. So as we know, right, as we just saw, right, the rate for the computer is going to be 35%. So we take $1,200 times 35, and that gives us $420. And then for the machine, the rate was 3.57%, right? So we take 3,500 times 3.57%, and that gives us 125. Right. So again, it should not be like, the whole process should not be that complicated, right? You just need to navigate through those tables and then pick the correct rate, right? And also have to pick the correct convention as well, right? So that's all you have to pay attention to, right? But even though it seems to be quite complex, it should not be that difficult, right? The more you do, the more you're gonna get familiar with the process, and you're gonna do it very quickly. Okay. All right. So let's talk about. So what we should talk about is the way to depreciate personal properties, right? Meaning all tangible properties except for real properties, right? So what happened to real properties? How do we do it? So for real properties, we cannot use the mid-year, the half-year, or the mid-quarter convention. We have to use the mid-month convention, which is even more strict, right? And then the recovery period for the real property is going to be also be different from the tangible asset, right? Because real properties usually they have longer life than other assets, right? So for depending on the type of the properties, we have a different recovery period, right? So for residential properties, the recovery period is 27.5 years. For non-residential properties that are placed into service after May 30th of 1993, the recovery period is 39 years. And then before that, if the non-residential property was placed in service before May 13th of 1993, then the recovery period is 31.5 years, right? And then the method to be used in calculating depreciation for real properties is going to be the straight line method, right? Instead of the double declining method when we calculate the depreciation for personal properties, right? So everything is different, right? So be careful, right? You have to figure out what type of properties that you are trying to calculate, right? If it's a real property, it's going to be a different ballgame. Okay. All right. So again, depending on the life, right? So we also have a table for the real properties, right? So this is the table for the Maker table for residential properties, right? Which has 27.5 years of useful life, right? So again, depending on the month that the property is put into service, right? Because we use the mid-month here, right? Depending on the month that the property is put into service, and depending on the year that we are trying to calculate the depreciation expense, then we're going to select the correct rate, right? All right. So this is the table for residential properties. This is a table for non-residential properties that are placed into service after May 13th of 1993, right? So it's look much more simpler, right? Much more easy, right? So again, depending on the month that we select the column, depending on the year that we're trying to calculate the expense, then we select the correct rate, right? And then finally, this is the table for non-residential properties that are placed into service before May 13th of 1993, right? And since the recovery period is 31.5 years, it looks quite different from this table. So, but still, the way we use this is exactly the same, right? Depending on the month that the property is put into service, and depending on the year that we try to calculate the depreciation expense, then we select the correct rate. Right. All right. So let's look at this example. Right, so we say on July 12th, this company purchased and placed in service the warehouse and the land it resides on for $170,000. $120,000 is allocated to the building and $50,000 to the land. What is the amount of depreciation on the property for the first year? Right. And in here, in this example, we only calculate depreciation expense for the building, right, whose basis is $120,000. Right. We ignore the $50,000 because land doesn't depreciate, right? Only the building depreciate. Right. All right. So we know the basis is $120,000, and this is a warehouse, so it is a non-residential property, and the company put into service after 1993, right? This is 2018. So we look at this table, right? For the first year, first year, right? And the month that the building is put into service is in July, right? So we know the rate is 1.177%, right? So we get back to our problems. We take $120,000 times 1.177%, and that gives us the depreciation expense for the first year that this building is put into service, right? So again, for real property, you have to be careful with the type of properties, right? So for residential, for non-residential that are placed into service after May 13th of 1993, and non-residential property that put into service before May 13th of 1993. So there are three types of real property that you have to pay attention to, right? So yeah, so I think that's the end of our discussion for depreciation. That's all of the method that we're gonna use to depreciate properties for tax purposes, right? So before we end the lectures, I just want to go through this example with you. Oh wait, I forgot to mention about the what happened when the company is trying to dispose the building before the end of the recovery period, right? So for the mid-month convention for property, for real property, right, it's a little bit more complex, but it should not be that hard, right? So you just follow these steps, right? So first we determine the amount of depreciation deduction for the year as if the asset is not as if the asset was held for the entire year, right? So again, first thing to do is to calculate the full year of depreciation, right? Step 2, subtract 1/2 of a month from the month in which the asset was sold, right? Step 3, divide the amount determined by step 2 by 12, and then step 4, multiply step 3 amount with step 1 amount. So even though the steps are quite confusing, right? But if you look at the example, it's going to be very easy, right? So first of all, calculate the full year depreciation, right? So here we get it, right? We find the rate based on the right table and the right column, right? So we calculate the full year depreciation, right? And then because this company, they're trying to sell the building, they sold the building on March 5th, in March, right, on 2019, which is the second year, right? So we follow step 2, right? We take 3, subtract 0.5, so 2.5, because this is a half-month convention, right? So they assume that, right? We assume that the company sold the building in the middle of the month of March, right? And the company hold the building from beginning of the year until the mid-month of March, right? So that's why we take 3, subtract 0.5 here, and that gives it 2.5. And then we take 2.5 divided by 12, right? Because that's how much time the company held the building during 2019, right? And then we just take the full amount, the full year depreciation times 2.5 divided by 12, right? And that gives us the depreciation expense in the year of disposition, right? And remember that the year of disposition here, in this case, is before the end of the period, right? The end of the recovery period, right? All right. So before we end the chapters, I just want us to go through this example together. You know, just another practice problem. And this example I took out from your homework, so hopefully that helps a little bit. All right. So let's look at this. So we say this corporation is acquired and places in service the following asset during the year. So we have computer. Date acquired was March 10th, and the basis was 14,500. Furniture, date acquired May 5th, and the basis was 26,700. And then commercial building that acquired was August 25th, and the cost basis was $333,000. Right. So in this case, we have 2 personal properties and 1 real properties. Right. So first of all, let's look at the personal property first. So we have 1 property acquired in March and 1 property acquired in May. So both of the properties are not acquired in the fourth quarter. Right. The first one acquired in the first quarter and the second one acquired in the second quarter. So that means we can use the half-year convention. Right. All right. So so let's calculate the depreciation expense for the personal property first, right? These 2 first, right? So we know that we can use the half-year convention, and then we know that computer equipment, the recovery period is 5 years, and for furniture the recovery period is 7 years, right? So with that, we're going to go back to the half-year convention table to try to find the rate, right? So let's go back to the table. So here's the half-year convention table. So we know for the first year, for year 1, right, for 5-year recovery asset, the rate is going to be 20%, and for 7-year recovery asset, the rate is going to be 14.29%. Right. All right. Remember these 2 rates. Now we go back to our problems. Right. So for computer, right, 5-year recovery period, the rate is 20%. And for furniture, recovery rate is 14.29%. So we take the cost basis times 20%, and that gives us the cost recovery, pretty much the depreciation expense for computer equipment. Right. Similarly, for furniture, we take the cost basis, which is 26,700 times 14.29%. Right. And this is the rate that we just saw. Right. And that gives us 38.15 of depreciation. So these 2 are personal properties, right? So what about the building, right, which is commercial property, right? Non-residential properties, right? So because this building is a non-residential building and is placed into service after 1993, right? So we use this table. So the useful life, the recovery period is going to be 39 years, right? And this property is placed into service in August. So we look at the August column. August, right? And in year 1, the rate is going to be 0.963%, right? So 0.963%. So we go back to our problems. So 0.963%, right? So similarly, to calculate the depreciation expense, we take the cost basis, which is $333,000, times 0.963%, and that gives us $3207 of depreciation expense, right? So that's it. Right? So that's how we calculate the depreciation expense for each of the asset, right? So as I said before, it should not be too complicated, right? It's just a matter of practicing, right? So if you practice long enough, you should be able to calculate this, right? And in the exam, you know, if I ask questions like this, I will provide you with all of the makers tables, you know. So all you need to do is to figure out the right convention and then the right type of properties, and then try to find the correct rate, and then just use the rate to calculate the depreciation expense, right? All right. So I think we should end the chapters here, but I mean, I should end the lectures here. So I will make another video, a second video, to cover the rest of the chapters, you know. All right, pretty much it. So I will see you in the next video. Take care.